Good afternoon, good day, wherever you are in your time zone. This is Jim Kinney, and of course, this is the weekly market update for OptionProfessor.com. The date, of course, is December 7th, and of course, that's a day of infamy in history, and today it's not very infamous as far as the bulls are concerned, but I'll get into all that in a minute. Before every broadcast, that past performance is not necessarily indicative of future results, and that short-term trading and option trading involves substantial risk of loss, so it's not right for everybody. You should be consulting your clearing firm, yourself, and your advisor, whoever you deal with, to find out what, if anything, is suitable to you. All right. Now, background on myself real quick. I'm a graduate of Boston College. I've been in the investment arena here for decades, and I've conducted hundreds of seminars for thousands of people on the use and the risk of options. And I'll get into that a little bit as well. But what that all means at the end of the day is I think I'm qualified to give you my opinion and my view, and that's what I'm going to do here today. All right, stock market. I guess, you guys are probably wondering what's going on because it goes down 1,200 points, back up 1,200 points, then back down here. We're down about 393 as I speak right now, down 1.6%. NASDAQ's giving it up too, minus 126. Unemployment came out today. I think it was 155,000 jobs. They were looking for 190. I think wages are up over 3%, though, and I'll get to that in a little bit because that's one of my theses of what the future may hold. And not many people are touting that horn. So either A, I'm going to be very right, or I'm going to have to join the majority. All right. Now, let's take a look at the major indexes, and I'll give you a little overview. If you have just tuned in for the first time, and again, I do ask that all of you who do come, if you have any associates, friends, relatives, whatever, let them know how to get the link at OptionProfessor.com so they can attend and take advantage of it every week. Now, just an overview. When we went up to 29.50, and if you've been listening to me or the broadcast, I told you the market was very overbought. Why was it ever overbought? Because I used the moving averages quite a bit, and the 200-day moving average was down in the 2,600s, and we were at 2,900, and that's way, way overdone. I'll give you another example. Amazon was up at 2050, and their moving average was in the 1,500s. Way, way, way overdone. And when you get 20, 30, 40, 50% above your 200-day moving average, the likelihood that the market is going to gravitate back toward it, in my view, is extremely high. So when we were up there, what was I suggesting people look into? Collars. What are collars? That's where you sell an out-of-the-money call, you take the premium, and you buy the put. What does that do? It gives you an upside limit to the strike price you sold, but it gives you a downside protection at the strike price you bought on the put. Now, just think about all the stocks in your portfolio. Had you done that strategy when we're up at 29.50, would you be richer today or not? And the answer is pretty obvious. You would have been a lot better off, generally speaking. Now, market has gone back in the tank towards 2,600. Why did it stop at 2,600? My view, I have a long-term moving average on the monthly graphs, and it goes back 10 years. That moving average is still rising. That's why I'm still constructive on stocks, because the direction of the moving averages long-term is important to me. Now, what about where is that moving average? It's right around 2,600. So that's why I believe it stopped there as a technical point. Now, we went all the way back up to 2,708 today. Now we're back to 2,656. We are in a parameter, in my view, of a little bit over 2,680. A little bit above 2,800, 2,820, and 2,600. That's a couple hundred point trading range, and that's where we're in. You get above 2,825, I'll start listening to the bulls that there's this big advance coming. We get under 2,600, people think it's going to stop at 2,530 because it's the 52-week low. I wouldn't count on that. My experience and my, shall we say, opinion is that if it breaks that long-term average that's still rising, you could go 100 points easy underneath it, which would be 2,500 or less. So let's hope that that 2,600 holds if you're holding stock, because if not, it's going to get messy. And of course, if it is going to hold it, you are looking at an area where it would be a buying opportunity. Again, I do share some of the thoughts with Jamie Dimon of Chase that the economy is still very good and that people are out there spending, and that the idea that we're going into recession tomorrow night is a little bit silly. So basically, I'm saying that the stock market was very overvalued. It came back and actually went through fair value, and now it's actually actually a little bit under fair value. And if it can hold this 2,600 on the S&P, it could get back on the bicycle, particularly, again, if the Fed comes out and hikes on the 19th and then comes out and says something that, we're not going to be going crazy with the hikes next year, 3 or 4. We're probably looking more like 1 or 2. Again, if the economy is strong, we can take higher interest rates. And the economy is strong, no matter what people say. People out there spending 3.7 unemployment. What is that, weak? What is that? The Great Depression, 3.7% unemployment. Come on, let's be real here. But again, it has slowed down, and that's why the blooms come off the rose. With regards to the other thing, obviously, it would be nice if we stopped arresting Chinese people up in Canada, and it would be nice if Mr. Navarro would take a holiday in the Bahamas and stop talking to the press. Those would be very helpful things. Whether they're going to happen or not, I don't know. But obviously, fighting with China and doing things that are unpleasant to them is not the way to go. Having said all that, the numbers are still the same. 2,600 on the downside, 2,825 on the upside, back and forth, until those parameters break. That's my view. Again, one other thing in the option area that I talked about when we were down at 2,600, and when stocks like Apple are down at 170, if you're really, bought at a high point and you're afraid of, losing any more cash as far as, maybe it's going to 120, who knows, right? Well, one thing you can do is substitute your long positions with options, long-term equity options. Some are called leaps, some are just called long-term options, a year, 2 years out. Then you've got a fixed risk, so you know to the penny what you're risking, and you've got a decent amount of time to see it turn around. And the rest of the money you can throw into that money market that used to pay 0. That's getting, you can buy a 1-year T-bill and get 2 3/4. That's the wrong, or 2.5, 2 3/4, which is not terrible. So, if you can't stand the heat, but you don't want to run out of the kitchen, a substitute for buying the stocks or being long stocks would be the long-term calls. Again, not right for everybody, but it is a strategy to consider. And if it's right for you, it could take the heat off the back of your neck. All right. So that's basically the overview on the stocks. And of course, there was people aren't talking about this, but I'm going to talk about the interest rate picture because obviously that's on everybody's mind too. Okay, on the 10-year note. Okay, what have I been saying for the people who have been coming weekly? I was saying that the market on the bottom is at 280, and right now the resistance is at 320, 325. Why do I say that? Because that's what the chart's telling me. It's right in front of you, right? Once we broke under 3.05, that obviously put it into the negative mode. But you see that tail down there at 280? If that thing holds for the next week or two, we're going to go up and fill that gap at 3 in my view, and we're going to even possibly go higher because if the economic numbers on inflation and on wage inflation continue to grow, you can't keep Fed funds at 2% if the inflation is going 3 to 5%. And I don't know about you guys, but when I go out to buy things, whether it be Chinese food or whether it be at the store, the prices are definitely higher in my life. So I don't know what the CPI is going to report, but if I was reporting it, I'd be saying it's a lot higher than 2-3% inflation out there. That's for sure. So if those numbers start translating into a number that we see on the board, again, oil's down, God bless it, but it's only one factor, right? You do a lot more than go to the gas station during the week, right? So if everything else is kind of rising, and health costs are definitely rising, then you're looking at a situation where these interest rates may go back up. Again, I do believe, I concur with Jamie Dimon's view that if there's a bubble anywhere, it's in the bond market. Why would there be a bubble in the bond market? Use your brain. Now, how low are interest rates? 0? For how long? Tremendous amount of time. 8 years, maybe, or more? Okay, so what was going on during that 8 years? Well, the government was issuing bonds, and companies were issuing bonds, and companies that shouldn't have been issuing bonds probably did. And then you've got municipalities issuing bonds, not to the greater degree, but there's a lot of debt out there. Now you throw in the international picture. You don't think those international people are issuing bonds? These are loans, right? You're loaning your money to somebody and they're borrowing it. Their ability to pay you back is very important, as you saw with the real estate loans. So what does that mean? If things are slowing down internationally, and if some companies are slowing down, what's their ability to pay back some of those loans at some point? Now, I don't know how much you guys know about the bond market, but sometimes it's not the most liquid thing in the world. Why would that be? My opinion is when people want to sell stock like Apple, you can probably find somebody who doesn't own Apple or might want to pick up some more, right? But when they go to sell these junk bonds or high yield bonds or things like that, generally the buyers on the other side are dealers, right? Now, if the dealer already has a bunch of these bonds and he's probably trying to get out too, who's going to be buying stuff that people are dumping when the people that would buy it already own the dumpy stuff? So that's one of the problems with the bond market as far as liquidity. And with these ETFs, people, the individual investor, I think, have been deluded into thinking they're liquid investments when in fact, during many times, they're not. So what's my point? My point is I think these interest rates still are very much possibly going to the upside. If you took out 2.5 on the Treasury note, then I think the recession talk that's been running around, I think prematurely, would actually have some merit. So that's the way I would look at the parameters. We hold 280 and then we go back up. We go under 250 and then start thinking that the recession is real and start putting more weight on how you want your portfolio to look during a slowdown in the economy. Okay, that's how I'm seeing the Treasury market. Again, one other thing is open interest got extremely high on the Treasury note. Now, if the market is going up, up until recently, what do you think people have been doing? Well, when interest rates go up, you short the bonds. And the moving averages were way down here at 2.8 and 2.9 when the market was up at 3.20. So now you had the market overbought from its moving average. You had open interest, meaning the pairs of contracts on the futures, extremely high, which means a lot of people are short and you're in an oversold condition. In this case, overbought because you're looking at the yield. What happens when you get into that situation, not unlike stocks, it goes the other way because in stocks, people are liquidating. In the bond market, people were short. When you're short, how do you get out? You buy. And so when you buy, you get a very big short covering rally. I think that's a big part of what's gone on in Treasury notes is an order imbalance that has been corrected, not unlike the stock market order imbalance was corrected during this drop. Okay. But the long term trend for interest rates, in my view, because I look at the moving averages, are still pointing down in the bond market, which means higher rates are the more probable than lower rates at this point. I'll update you as I see the facts, but that's how I see it right now. So that's the story in the bond market from what I see. And I gave you a little bit of an overview on the S&P. So that gives you a little bit of overview. Let's look at some sectors here real quick because some of you guys are stock specific and four of them that people seem to like. One is the healthcare. So let's take a look at an ETF on healthcare. And oh, wait a minute here. Got the wrong symbol up there. That's not going to help us. All right, there you go. And there's many, what do you call it? There is many ETFs out there. I'm going to be referring to some of the fidelities, but there are many out there. Okay, healthcare today getting whacked pretty good, down 2%. But look at that. It has been going up quite a bit overall, and now it's given up the goose. Okay, again, still above its 160, 165 support, so that's not bad, but clearly it's on the defensive. This may also be a casualty of people are losing money on other things, and so they're selling out some of their winners. Okay, but that's that overall, that's been one of the better places to hide during this downdraft. Next one is utilities. Okay, the utilities obviously still hanging in there. So not a bad place to hide. In this Fidelity one, I mean Vanguard one, you got about 3% yield and you're at about 125. So you could shout and hit the all-time or the 52-week high. So that's not been a bad place to hide in utilities. You get paid a dividend and your principal looks like it's doing pretty good. Not a bad place to hide so far. Another place people are saying is a good place to hide is the REIT area. And one that I've kept an eye on is hold on a second here. Annaly. You know, there's risk in these REITs, so you got to look at the prospectus. You got to look at what it's all about. But they do yield pretty good. A lot of these. Some of them, are less, like 5.5. This one here is going to be a high yielding one at 11.84. That's a heck of a big yield. But you can see it has dropped in price. But you can also see that while the market has been dropping in the last 2 months. Let's look. The last 2 months, look at October, November, December. It's actually gone from 975 up to 1013, and it's yielding 1184. So this has not been a terrible place to hide either. It's been a terrible place to be since last year during that drop. But again, you are getting a very handsome yield there, and the P/E ratio of 4 doesn't look too bad. And it is, I think, a $3 billion cap, so it is a little bit of a larger one. But again, there are diversified REITs at Fidelity and Vanguard and Schwab and everywhere else. Okay, but I'm just showing you one here just as an example that people have been hiding out in REITs in the last 90 days. They've been getting paid, and their principal hasn't gone in the toilet. And those are three good things, right? Right. Okay, let's get back here to a couple of other sectors. Let's see how the consumer's doing. Are they giving up on him? Here's a consumer discretionary. 2/3 of economic growth, right? 3.7 unemployment. Down a little bit today. Yeah, it's giving it up a little bit. Again, it came off pretty hard. And again, some of those stocks were overdone, like Ross Stores and Target and all those got a little bit overdone. But again, we're almost at the 2,600 support. So you got to imagine these things will be down near their support during that period. What you don't want to see is you don't want to take it out 155 and going into the abyss. So you got to monitor these things. Again, when it was up at 185, and if you were listening to me, I would have told you the moving averages are down in the 160s. You're up at 180. Look at your collar strategy. How does that work? If you have any questions on this, you can give me an email, optionprofessor@gmail.com. Give me some contact information. I'll talk to you directly. We'll go over your questions. I'll explain the use and the risk. You'll go back to your clearing firm to see what's appropriate or not for you or your advisor, and then you can see what you want to do. Okay? But the bottom line is if you don't understand the strategies, you can't do them. And even if you do understand them, that doesn't mean they're right for everybody. Okay, next one's going to be Eck. Let's look at some of the individual stocks. How's Apple doing? Apple's right on the floor, 170. Okay, that's the area where I thought it might stall, but if it goes through here, 150 certainly not out of the question. Okay, again, when they came out with the curveball, what was the curveball? The curveballs, we're not going to tell you how many iPhones we're selling. 60% of their business, I understand, is iPhones. Does that sound like a problem? You're not going to tell us how many iPhones you sell? It was a curveball, and what did the market say? We don't like curveballs. We like straight fastballs, right? So that's why you go from 230 down here. Again, when you're at 230 and the moving averages are at 180, what am I going to explain to you? I'm going to explain how the collar works. Why? Because you're still in the game because you're going to sell an out of the money call, but you're going to put a floor underneath this equity. So rather than having it go from 230 down to 170 and you're going in the toilet, that put would have offset that risk a bit, right? Okay, but you got to know the strategy to do the strategy. And then, of course, you got to be suitable to do it. Okay, that's Apple. What are we talking here now? Let's talk about Amazon. That's the poster boy of overbought. Again, if you had a high multiple, P multiple, now, what do you call it? It's only at 14. And they got a boatload of cash if they want to buy their own stock, Apple, right? So, that's something to sniff around between 150 and 170 if you think this thing is going to be any good. This is the time not to be panicking, time to see if you want to put your toe in. Now, Amazon, 1660 down 39. Again, we were at 2050. Moving averages were at 1500, 1550. Well, look at that. 2050, look at my cursor. 1550. Is that overbought or what? So, of course, it came back down. And now the P/E ratio is still 93. That's certainly not cheap. These guys are obviously into everything you ever wanted to do. But God help them if the economy does slow down. One thing that gave me an idea that Amazon was overvalued is their market cap was almost $1 trillion, while Walmart was only like 372, and the revenues to Walmart were almost twice what Amazon has. So Walmart has twice the revenues coming in, and it had 1/3 or so of the market cap. I said to myself, Amazon looks a little bit overdone here. Plus, it's 500 points above its moving average. So again, where will Amazon go? It'll go probably wherever the economy goes. And again, on big dips would be the time to think about it. But you've got to be concerned that the high valuation stuff is not of a big appetite right now. Let's take a look at Facebook. Got nailed, right? Because what are they doing with our data? I don't know if they still have explained it clearly enough. But that was another one that got way overdone. Look, right? What do you think the moving averages were when we were up at 220? way underneath. I'll help you with the math. And what happens when it's way above the moving average? At some point, it comes back. This not only came back to the moving average, it went through it like a knife through butter. It's trying to hold this 126 low. So that would be definitely my line in the sand if I wanted to take a look at this thing. P ratio is not terrible, and they still got a zillion users, but they are slowing down, and some people are leaving. I got kids. They tell me this is yesterday's story as far as social media, but my kids in that generation is only one group. There's a lot more people than just the kitty. But again, they're having problems increasing their user base. They still got a ton of them, so that's the thing. They can still market to them. But again, there's your line in the sand, 126, and of course, if it stays above that, that's constructive. And if you get above 160, then it might be back on the bicycle. There's a big gap there between 210 and 190. You would think that at some point it will go after that, unless the story's totally changed and it's over. Then that's a different story. Okay, let's take a look at some other stocks that people might have an interest in. Boeing got nailed pretty good. Why is that? Pretty good because we spend what $700 billion a year, and next year $700 billion a year. And some people are now saying we need less bombs and we need more band-aids. Let's cool it with the bombs and let's start making some band-aids. What does that mean? We need more in healthcare. People are aging. Me too. And we got to go to the doctor, and we don't want it to be a catastrophic problem every time we go to the doctor, right? Or we have to go to the hospital for something. So the bottom line is there's a drum beating out there, and with the Democrats taking over the House, that drum's going to get louder, that we got enough planes and bombs and drones and everything else to choke a racehorse. And what we need more is lower health care, lower drug costs, and stuff like that. Well, that's not going to help these guys. And obviously, that's, I think, what took the bloom off the rose here as well. So you used to be at 390. When you're at 390, where are the moving averages? Probably around 340. And what happens? Comes back to it, and boom, blows right through it, right? So the bottom line is this still has support at 300, and I would use that as a line in the sand, or 280 to 300. And then, of course, if it can hold this area and they get some more orders and things turn around, it could resume back up. But again, this is a sector, including Raytheon and Northrop Grumman, that's been getting whacked because the drums are starting to pound a little bit, that we might be spending a little bit too much on defense. I don't know what the Taliban's spending on defense, but it ain't 1.4 trillion, right? Okay, what else have we got going on out there? How about the banks? They seem like they got whacked pretty good lately. Citigroup in particular. Why is Citigroup having so much trouble out there? Because they are an international bank more than the others, and the international picture is not looking so good. So what does that mean? One of the problems is when people start hitting the recession drum, they like to hit the banks, because if a recession does hit, who has the biggest risk? Well, the banks have a huge loan portfolio, right? And if the loan portfolio is in jeopardy, then obviously the banks are in jeopardy. But look at this volume blow off here in the last couple of days. The volume up was almost 4 million shares. Today, 7.4 million. Let's go look at what the normal volume is, because it could be getting near a low point that might be what they call capitulation. Let's take a look real quick. I mean, everyone was pounding on the banks at 80, this stock at 80. I wouldn't buy it at 80 for love or money, but now you're at 55, 50, 60, whatever. That's a lot different price. So the normal volume on this thing is 17 million. Okay. So basically, if you, that might have been 40 million we were looking at. And anyway, you could see from that graph that the volume was very, very high. You see this area, the former highs over there? Look where my cursor is. Former highs over there in 17, right around 58 to 60. So this neighborhood here, if it stabilizes, could be a decent area if it can turn around. It's getting to be 10 bucks, almost 20% underneath its 200-day average. So it's getting a little bit oversold. Keep an eye on that. But again, with the inverted yield curve, that could squeeze their profits. And with Citi, if they have trouble overseas, could be a problem as well. That is one of the sectors people keep pounding, though, is the banks, the banks, the banks. So if you wanted them cheap, they certainly are as cheap as they've been in a long time. So if you want to sniff around, but put some lines in the sand or put some option strategies on as a hedge, so that if it does get really messy, you've got some protection one way or the other. Okay, so I'm going to go over a couple of other things now. The U.S. dollar. U.S. dollar is at 96.67. I've been telling you that there seems to be some type of a high point that's developing at 97.50. Can you see it went up there, came back down, went up there, came back down, went up there, didn't even get up there? If we break under 96, I would say that the dollar has given you the yellow flag. If it gets under 94, then the dollar has given you the red flag, and that means the dollar would be dropping. And then under 96. That may help the stock market for the international firms. It could also help something else that I'm going to show you right now, and that is in the gold market. Gold has been a dead topic for a very long time, and people aren't very happy about talking about it because it's been a very dead subject for a very long time. But dead subjects sometimes turn because the world doesn't stay the same. The sun keeps turning around the world, and that's why we have cycles, right? So the bottom line is this thing had been in a very, very down cycle for a long time. And now what do you got going? You've got it bottoming at around 17, going up to 20 and a half, back down to 18, never took out 17. Now it's at 20. If we can take out 21, 22, 23, then I would say that this is in an uptrend. And if you see the dollar taking out 96 and 94, I would start allocating some money into the gold market. I like to have some gold in the portfolio all the time. That's just my opinion. That's just my view. But if it was above 22 or 23, I'll probably be adding. Okay. Because this thing can go a long way if things get out of control. What does that mean? It means we got 3.7 unemployment. Wages can start going higher than 3%. And like I tell you, when I go around town, stuff that I buy outside of my gas tank is going higher. And if they start cutting production and try to squeeze the price there, that's going to go up too. So again, you can't have 2%. What do you call it? Fed funds when you've got 3, 4, 5% inflation going on. If that starts coming out like that. We saw that in 1980, 82 when inflation was at 10% and the Fed funds was at something like 5. And then they had to go crazy putting it way above the inflation rate in order to get the inflation to come back down. And Powell is a history man. He understands that. So that's why, he's not going crazy with interest rates. A zero interest for 8 years was crazy, right? It causes bubbles when you do stuff like that. And then the guys like Powell have to deal with the aftermath. So the bottom line is keep an eye on the gold, because if the dollar's going to break, it has not done that yet. But if the dollar is going to break, it would be a situation where these gold stocks could start flying a little bit. So keep an eye on that. Okay, let's see what else is going on. Yeah, one other thing in the commodity sector would be the soybeans. Why is that? Because soybeans have been in a lot of trouble. I've heard there's been a 50% jump in bankruptcies by farmers. That sounds like blood in the water to me. Now, the thing is, and like I say, I take no joy in saying that, but I'm saying that's what's happening. Now, the story is China's obviously not been buying the beans, and that has been a problem. Now, I've told you for the last weeks and weeks and weeks that the support on this thing is $8 a bushel, and resistance is at 9. So we broke above 9 after the meeting of the deal that was no deal last weekend. And now you can see that it is breaking above 9, right? And the volume's picking up. So keep an eye on this. I would imagine that if we can sustain above 9, and then you can see 925 was a hurdle, and it has not been able to get above that hurdle, that it could go up towards 10, which is the lows over here. So the bottom line is there could be a potential to the upside here. It does look like it's been building. But of course, it could collapse at any time. But the bottom line is, if I'm hearing the farmers are going bankrupt, that sounds to me like maybe they won't plant as much next year. And if the Chinese do start buying our stuff again, this obviously would be a very big buyer for this market and would put a bid underneath the market. And of course, if the supplies get pinched because the farmers are out of business or bankrupt, then obviously there could be a supply-demand dynamic that could be quite positive. Weather, who knows? Drought, no drought, whatever. There could be other variables that hit this thing as well. But I'm smelling a little bit of a turn here. You can never trust these things fully. So whatever you do, try to keep the risk limited and try to keep it on a short leash. But again, it is above 9 now, which is constructive. Above 925 would tell me that the horse might be running out of the barn. All right. Again, I'd like to remind everybody who's listening here today that if you have any friends or associates that you'd like to refer the broadcast to, because I do come on here weekly, you simply tell them to go to OptionProfessor.com and have them go to the link and they could take advantage of it. Again, if there's any questions or comments you have for me, OptionProfessor@gmail.com. Remember, it's singular. OptionProfessor. Again, on behalf of myself and everyone, I would like to thank everybody for being here today on December 7th, 2018. I will be back with you next Friday. Again, enjoy your holiday season. And if you have anything for me, just let me know. Otherwise, good luck, good trading, and I'm back with you next Friday.